Hey guys, it's Mrs. Lamphere, and in this video we're going to go over the assignment, transaction clarification. So this is assignment 3 from unit 3, so the last assignment of this unit. And you should have already watched the YouTube video I sent out, which was the lesson over the text, because we do learn about some new accounts that we're going to be working with, as well as whether they are permanent accounts or temporary accounts. So make sure you have already watched that lesson recording before completing this assignment, because I'm just going to help you get started on these assignments and then you guys can do the rest. So we have in part 1, and you'll notice there are 4 different parts to this assignment, but in part 1 we are St. John Paul College of Engineering, and we are keeping the accounting books for them, and they receive the following fees from students. They receive tuition fees, library fees, and special fees. So that's money that the college is bringing in. So that is considered revenue. And we talked about revenue in the video lesson that I sent out. And then we also have $2,000 that the college is paying out in examination fees to Chicago University. And originally, the instructions have you prepare just a fees account, but I'm switching that up a little bit just so you guys kind of get more familiar with these revenue and expense accounts. And then we're also going to add a cash account, because I know, so this assignment only wants you to look at one account in the transactions that are being made, but I want you to stick with the whole routine of having a debit and a credit, and keeping with the theme of two different accounts being affected with every transaction. So we're going to stay with that theme. So I need you to copy and paste and add a cash account here, because all of these transactions are also going to affect the cash of our business. Okay, so the first thing we need to do is determine whether these expense, revenue accounts, and cash. You should know cash by now as an asset. We're going cash increases on the debit side, decreases on the credit side. But these expense and revenue accounts, these are some of those new accounts that you learned about in the lesson. So hopefully you have your handy dandy accounting reference guide open. If you don't have this yet, you can find it on our course homepage. It's there in the class news. There's a link to this download. Actually, and I also think I have it in the content tab, so make sure you're getting that downloaded. All right, so you can tell you can see in our accounting reference guide, the expense account should be increasing on the debit side, decreasing on the credit side. Here's our revenue accounts, should be decreasing on the debit side, increasing on the credit side. So, and then we're actually going to take these a step further. So this is our fees revenue, because businesses can have a lot of different expense accounts and different revenue accounts. So we need to be specific about which revenue account this is affecting and which expense account this is affecting. So go ahead and add fees expense and fees revenue as those account names. All right, so first we are collecting tuition fees of $10,000. And so, which tuition fees, that's a revenue for us. So we're going to record $10,000 as an increase to our revenue. But first we have to decide, all right, so is that going to be a debit or a credit? When we looked at our reference guide, we see that a revenue account increases on the credit side, decreases on the debit side, and an expense account is just the opposite. Because an increase in expenses ultimately is going to decrease our owner's equity, right? The more money we put towards expenses, the more money is going to come out of the business, and which is opposite with revenue. The more revenue we have coming in, the more that's going to increase the value of our business, right? So we have $10,000 coming in as tuition fees, so we know we're going to increase, that's revenue coming in, so we're going to increase our revenue account by $10,000. So there's our credit, and as you remember from previous lessons, we need to have a debit and a credit for each transaction. So since we are crediting revenue, we're going to debit cash. Because again, we have that $10,000 coming in. Sorry, that little line was bugging me. So we have $10,000 coming into the business as revenue, and that $10,000 is cash or check, or however the students are paying it. It's going into our cash account. We could call this cash in bank. Maybe we're taking it straight to the bank. Okay. Next fee, library fees. So that's again fees that are coming in. So record that revenue should look just the same as the $10,000 revenue. So you can, I think you can handle that debit and credit, and also the special fees debit and credit. Let's look at the fees that the college paid out. So fees expense. So we're paying out $2,000 in fees. Now, a lot of students, when it comes to these expense accounts, make the mistake of, well, I'm paying an expense, that's money leaving, so that should be a credit. But actually, we're increasing the amount of money that's going towards that expense. That's how you need to look at this transaction. So this is our debit, the increase in the expense. We're increasing the amount of money we're putting towards our fee expense. And that's money coming out of the business. So that's going to credit our cash and bank. We're writing a check to Chicago University. It's coming out of our bank. We're putting it towards that expense, but it's ultimately leaving the business. That's kind of how you would look at that whole kind of circle of life of that $2,000 within our business and how it's leaving. Okay, so finish those revenue fees on your own, and then make sure you're coming up with the balance. So I want you to calculate the overall balance of the owner's equity account. So once you have all your revenue in there, look at your revenue versus your expenses and tell me what the balance of this owner's equity account is. Okay, so just a heads up, you should have it be recording the balance on this credit side. Okay, part two. Part two is very similar to kind of what we did in previous assignments by just determining whether these are assets, liabilities, owner's equity, but now we're also adding in expense, revenue, and withdrawal accounts. So John David uses the following accounts in his business. Identify the two accounts affected by each of the following transactions and indicate whether the account is debited or credited. So we don't have to say whether it increases or decreases, but that should kind of be also in your head too. So John David invested $50,000 into his business. So we have $50,000 starting off a business. What account's being debited? What account's being credited? Make sure you whip out your reference guide so we know as starting up a business that always affects our cash. You could call it cash or cash in bank. Maybe you're putting it straight into the bank. Cash usually means like cash on hand that they have at the store. And then that's also going to affect your capital account. Remember, we have our owner's equity accounts always starts off with the owner's name plus the word capital. That's usually the name of our owner's equity account. So we should see an increase in both our cash and our capital account. We're starting the business off. So I'll let you determine the debits and credits for each of those. Make sure you're looking at your reference guide. So that's all you have to do is determine which accounts debited, which accounts credited, and then type those names here. And make sure you're basing it. So he's using cash and bank, so that we have to use cash and bank. And his capital, should be called John David Capital. And so that's the name of the capital account that we'll be using. So make sure whenever you're listing an account that it comes from this list of account names here. January 4th, billed a customer for goods supplied worth the $7,000. So obviously this customer did not pay cash up front. What does that tell us is this customer owes us money. We're billing him. So what accounts is that going to affect? Okay, he bought some goods from us, so that's money coming into the business, right? So you should kind of think about maybe sales revenue. I'm going to help you out with this one. Sales revenue, and since he didn't pay cash, we're billing him. That would affect our accounts receivable. So if it had said paid cash for goods, then we would not bother with cash or with accounts receivable. That would just go straight into cash and bank. But since he's paying Since we're billing him and he's paying later, that's going to affect our accounts receivable and our sales revenue. So you determine, again, using your reference guide, which account's being credited and debited. Issued a check for inventory purchased worth $10,000. So we're writing a check, so that means that cash is coming out right away. They're not billing us later. We are buying the inventory now. So again, where's that money when we write a check? That money comes straight from the bank. All right, so that's the difference. If it would have said that we are paying off inventory that we purchased a month ago, then that would be affecting our accounts payable. But we are writing a check right now for inventory that we're buying right now worth $10,000. So that money would be coming out of our bank, and something that we purchased, so a purchase expense. So bank and purchase expense for that one, and then you determine which is being debited and credited. Okay, last one, salaries paid to the staff, $5,000. So whenever we are paying salaries, that's always going to be an expense for the business. It's called salary expense. And so we are writing a check for $5,000 to pay off the salaries of our employees. So again, salaries expense, and that check is coming out of our bank. Well, it doesn't say check, but it doesn't, unless there's a strong indication that it's something being paid at a later date, it's going to affect cash. Okay, so I know a lot of students want to straight go to accounts payable a lot of the time, but unless it's being paid at a later date, which that doesn't indicate here, it's coming out of cash. Okay, so that's part 2 of this assignment. Again, you just need to determine which is debited and credited in all those scenarios. Part 3, a company had the following economic activity during the accounting period. They brought in $50,000 of revenue. They had $2,500 go out as salary expense, $3,000 go out as advertising expense, and then they deposited a check from owner's personal savings. So this is just another investment in the company of $5,000. And then Mr. Nicholas removed an office computer for his son at the cost of $750. So that would be like an owner's withdrawal. He withdrew something of value from the business. So we're going to record that in the owner's withdrawal account. Determine the end balance of the owner's capital account. Okay, so this is one, I don't really like these types of examples. So instead of splitting these all up into their temporary accounts, like revenue, expenses, withdrawals, they want to just see the straight impact that this has on the owner's capital account. So money coming in as revenue, that should probably increase, right? And so there's not going to be a debit and credit recording. They just want to see, so normally, obviously, we would be having another account that's being affected with all of these transactions. But for this exercise only, we're looking at just the owner's capital account and how it's affected. So revenue, that's going to increase, right, our business by $50,000. Salaries expense, so that's going to, an expense is going to decrease our business, so $2,500. Then we have an advertising expense for $3,000. And we have deposited check from owner's personal savings. So again, we talked about how that's an investment into the business. We don't care about owner's personal savings account. We only care about how it affects the business. So that's an increase to the business by $5,000. And then he removed a computer for his son at the cost of $750. So that would be like an owner's withdrawal. Instead of withdrawing cash, though, he's withdrawing office equipment. So it's ultimately it's taking money, it's taking value, though, away from the business. So that would be a debit. So now I'm going to leave it up to you, and you can use your reference guide. But what is the balance now of this owner's capital account? Our credit compared to our debit, what's the balance, and which side should that balance be recorded on? So I'm going to leave that for you to determine. All right, and then on this last one, very similar to I think we did something similar to this in the previous assignment. So we're going to look at each of these accounts listed here, determine if it's an asset, liability, owner's equity, withdrawal, revenue, or expense account. So you have 6 different choices now. So looking at these different accounts, you're going to determine what type of account it is, whether it increases on the debit or the credit side, whether it decreases on the debit or credit side, and then which side the normal balance is recorded on. All of that information is available in your reference guide. You just have to determine what type of account these are. Some of these are kind of tricky. Cash in hand should be pretty easy. David's capital, David's withdrawals, that's kind of a clue in itself. Accounts receivable, advertising account, fuel oil account, repairs account. So you need to look at these as these are money going out, right? We're paying for advertising, we're paying for fuel, we're paying for repairs, we're paying for food expenses. So since all that's money going out, that should help you with what type of accounts these are. And then we have accounts payable, so that money that we owe. So make sure you are determining what type of accounts those are, which side increases, which side decreases, and which side's the normal balance. And then that is it for this assignment. That should say part 4. So that should help with getting you started. Make sure you're watching that video I sent out also with the lesson going over the text to really help kind of clarify some of these different accounts. And if you have any questions, let me know.